What if the very ground beneath America's housing market isn't as solid as we think? What if rising waters, not financial mismanagement, could trigger the next collapse? And what if the most valuable asset for millions of Americans, their homes, is already quietly sinking under the weight of a hidden crisis? Floods are often thought of as short-lived disasters, sudden storms that overwhelm rivers, hurricanes that batter coastlines, or flash floods that surge through neighborhoods before disappearing into the ground. Yet, behind the scenes, floods represent a far larger and more insidious threat to the stability of the US housing market. This threat doesn't make headlines as frequently as Wall Street meltdowns or mortgage scandals, but it has the power to destabilize property values, force entire communities into financial ruin, and create ripple effects across the broader economy. To understand how floods could bring the American housing market to its knees, we need to look at the intersection of climate science, real estate economics, insurance systems, and human behavior. Each of these dimensions tells a piece of the story, and together they reveal a troubling picture of what may lie ahead. First, consider the physical vulnerability of the housing stock itself. Across the United States, millions of homes are located in flood-prone areas, along coasts, near rivers, and even in suburban developments built on former wetlands. For decades, these risks were either underestimated or ignored, thanks in part to outdated flood maps and a collective belief that levees, dams, and drainage systems could control nature. But as climate change accelerates, these assumptions are collapsing. Rising sea levels are eroding coastlines, storms are delivering heavier rainfall, and once-in-a-century floods are happening every few years. Homes that once seemed safe are suddenly at risk, and the cost of protecting or repairing them is skyrocketing. Now, place that physical vulnerability inside the framework of the housing market. For most American families, a house is their largest financial asset, the cornerstone of their wealth. Property values are tied to perceived stability, safety, and demand. When floods repeatedly damage homes in a neighborhood, buyers begin to hesitate. Why invest in a house that might be underwater, literally and financially, in a few years? As demand weakens, values fall. Lower property values mean homeowners lose equity, which can destabilize not just individual households, but entire communities. The situation is made even more precarious by the role of insurance. The National Flood Insurance Program, NFIP, established in 1968, was designed to provide affordable flood coverage in areas where private insurers refused to operate. But the program is heavily in debt, repeatedly bailed out by taxpayers, and increasingly unable to cover the magnitude of losses caused by climate-driven disasters. In recent years, NFIP premiums have begun to rise to reflect actual risk, leaving many homeowners shocked by sudden increases in costs. For some, the price of flood insurance now rivals or even exceeds their mortgage payments. Without insurance, a home in a flood zone becomes nearly unsellable, locking homeowners into a financial trap. With insurance, costs may rise so high that buyers walk away anyway. Either way, the value of those properties sinks. Financial institutions are not blind to this reality. Banks, mortgage lenders, and investors are beginning to factor climate risk into their decisions, though often quietly. Some lenders are restricting loans in high-risk areas or demanding higher down payments. Others are bundling mortgages from flood-prone regions into securities, echoing the practices that helped fuel the 2008 financial crisis. If a major flood event triggers widespread defaults, the repercussions could ripple through financial markets, affecting far more than just coastal homeowners. The psychological dimension is equally important. Housing markets thrive on confidence. If people believe a neighborhood is desirable, values rise. If they fear it is unsafe or declining, values fall. Flooding undermines that confidence in dramatic ways. Families who have experienced repeated evacuations or costly repairs may choose to leave, even if it means selling at a loss. Potential buyers who watch news footage of submerged streets or collapsing levees may decide to look elsewhere. Over time, neighborhoods once considered prime real estate, beachfront communities, riverside towns, even suburban cul-de-sacs, can see their desirability evaporate. The scale of this looming crisis becomes clearer when we consider how widespread the risk is. According to research from groups like the First Street Foundation, millions of US properties face significant flood risk, not accounted for in official government maps. States like Florida, Louisiana, and Texas are obvious flashpoints, but the problem extends to inland states as well. In the Midwest, heavier rains are overwhelming rivers and drainage systems. In the Northeast, rising seas are combining with storm surges to flood historic cities. This is not just a coastal problem, it is a national one. The economic ripple effects of a flood-driven housing collapse would be severe. Local governments rely heavily on property taxes to fund schools, police, and public services. When property values fall, so does tax revenue, forcing cuts to essential services or higher taxes on the remaining residents. Businesses that depend on stable, prosperous communities, from grocery stores to contractors, suffer as well. The loss of wealth among homeowners reduces consumer spending, which can drag down broader economic growth. And just as with the 2008 crisis, financial instability in one sector can spread through the entire system. Another layer of complexity is inequality. Wealthier homeowners may be able to absorb rising insurance costs, elevate their homes, or relocate to safer areas. Lower-income families often cannot. They are more likely to live in vulnerable neighborhoods, less likely to have savings for repairs, and more dependent on home equity for financial security. A flood-driven housing crisis would therefore not only destabilize the overall market, but also deepen existing divides, hitting vulnerable populations the hardest. The response of policymakers and institutions will shape whether this scenario becomes a catastrophe or a manageable transition. Some cities are beginning to implement managed retreat, buying out homeowners in flood-prone areas and converting the land back into wetlands or open space. Others are investing heavily in seawalls, levees, and stormwater systems, though these are expensive and may only provide temporary relief. At the federal level, reforms to the NFIP and stricter building codes are being debated, but political divisions often slow progress. Yet even with proactive measures, the underlying truth remains. Climate change is altering the geography of risk, and the US housing market has not fully accounted for it. As long as homes continue to be built in high-risk zones, and as long as buyers and lenders underestimate future threats, the potential for a flood-driven collapse grows. The warning signs are already visible. In some neighborhoods, homes that once commanded top dollar are now selling at discounts because of repeated flood damage. Insurance companies are withdrawing from certain states, citing mounting losses. Analysts are warning that trillions of dollars in real estate value may be at stake nationwide. For homeowners, this is not just an abstract discussion about climate science or economic models. It is a question of whether their single biggest investment will hold its value in the years to come. Floods may seem like a natural disaster, but their impact on the housing market is profoundly human-made. Our decisions about where to build, how to insure, and what risks to accept have created a fragile system that climate change is now exposing. If nothing changes, the next housing crisis may not be triggered by reckless lending or speculative bubbles. It may be triggered by water. For the millions of Americans who live in vulnerable areas, the stakes could not be higher. Protecting the stability of the US housing market will require facing hard truths about climate risk, making difficult policy choices, and rethinking the value of land in a world where the boundaries between dry ground and floodplain are shifting before our eyes. The question is no longer whether floods can destabilize housing. It is how long we have before the pressure becomes too great, and the market, like so many storm-battered homes, collapses under the weight of rising water. When people talk about the fragility of the US housing market, the conversation usually centers around interest rates, inflation, or the aftershocks of financial crises like 2008. Yet beneath these well-known economic factors lies a slower, quieter force, with the potential to be just as destabilizing: the rising cost of climate-driven flooding. To grasp the full scale of the threat, we need to dig into the structural vulnerabilities of the system, the economic feedback loops that amplify them, and the human choices that are leaving millions of Americans exposed to cascading risk. One of the most striking realities is that much of the US housing stock was built under assumptions that no longer hold true. Developers built suburban sprawl across wetlands, floodplains, and low-lying coastal areas, confident that flood control infrastructure and modest insurance premiums would keep these properties safe and financially viable. For decades, those assumptions seemed reasonable. Hurricanes came and went, rivers swelled and receded, and the system, though strained, held together. But climate change has fundamentally altered the baseline. Warmer oceans fuel stronger hurricanes, warmer air holds more moisture, and rising seas push storm surges farther inland. These changes make flooding not an occasional shock, but a recurring, intensifying feature of life in many regions. The implications for housing markets are profound. A home is not just shelter, it is a store of value, a retirement nest egg, and often a family's primary financial asset. When repeated flooding damages homes, buyers step back. The psychology of real estate is simple. Perception drives demand. A neighborhood that appears risky loses its desirability, even if only a portion of homes are directly affected. As demand falters, property values fall, and the negative feedback loop begins. Lower values reduce household wealth, erode local tax bases, and deter new investment, which in turn further weakens community resilience. Consider the Gulf Coast, where many communities are already experiencing this cycle. After Hurricane Harvey struck Texas in 2017, some neighborhoods flooded 3 times in as many years. Properties that once sold quickly now linger on the market, and buyers negotiate steep discounts. Some residents, exhausted by repeated cleanups, have accepted government buyouts. Others remain trapped, unable to sell and unwilling or unable to abandon their largest asset. Multiply these scenarios across coastal and inland flood zones, and the potential scale of housing market disruption becomes clear. The insurance system, designed to act as a buffer, is itself on the brink of collapse. The National Flood Insurance Program, NFIP, has historically offered subsidized rates, allowing people in risky areas to maintain coverage at prices well below actuarial reality. But the program is now more than $20 billion in debt, and reforms are pushing premiums upward to reflect actual flood risk. This shift has hit homeowners hard. In places like Louisiana and Florida, families are seeing premiums jump by thousands of dollars per year. For some, insurance now costs more than their mortgage. For others, the cost is so prohibitive, they simply drop coverage, rolling the dice that disaster won't strike. But lenders usually require insurance for mortgages in designated flood zones, meaning that without it, homes become practically unsellable. A single missing piece in this chain, affordable coverage, threatens to undermine entire swaths of the housing market. Private insurers, meanwhile, are retreating. Several major companies have pulled out of high-risk states, citing mounting losses from storms, floods, and wildfires. Those that remain often charge exorbitant premiums or impose strict conditions, leaving homeowners squeezed between unaffordable protection and unmanageable risk. As insurance markets contract, the ripple effects will spread to lenders and investors. Banks may hesitate to underwrite mortgages in exposed areas, or they may charge higher rates, effectively penalizing buyers for living in flood zones. Investors, too, are beginning to scrutinize mortgage-backed securities for hidden climate risks. If confidence falters, the financial architecture built on the assumption of stable property values could start to crack. The parallels with the 2008 housing crisis are not exact, but they are unsettling. Then, the problem was reckless lending and opaque securities tied to overvalued homes. Now the danger comes from physical risk and the financial products linked to vulnerable properties. If floods trigger widespread defaults because homeowners cannot afford repairs, insurance, or mortgages, banks will face mounting losses. Mortgage-backed securities tied to these loans could lose value, spreading instability through the financial system. Unlike 2008, however, this crisis would not be cyclical but structural. Floods are not a temporary market aberration. They are a new normal, intensifying with every passing year of climate change. What makes the situation even more precarious is the uneven distribution of risk. Not all regions are equally vulnerable, and not all households have the same resources to adapt. Wealthy communities may be able to build seawalls, elevate homes, or lobby for federal protection projects. Middle and low-income neighborhoods often cannot. They are more likely to face repeated losses, struggle with rising insurance costs, and eventually see their property values plummet. This geographic and socio-economic imbalance could create a patchwork housing collapse, where some markets remain stable while others disintegrate. Yet because the US housing system is interconnected through finance, insurance, and investment, localized collapses can still have national consequences. Take Miami, for example, one of the most climate-exposed cities in the world. Real estate there has boomed for decades, even as experts warned of sea level rise and recurrent flooding. Luxury condos rise along the shoreline, commanding millions of dollars. But behind the glossy towers, insurance costs are mounting. Flood risks are escalating, and buyers are beginning to whisper about climate gentrification. This phenomenon describes the migration of wealthier buyers away from low-lying, flood-prone coastal neighborhoods into higher elevation inland areas, driving up prices there while coastal communities stagnate. It is an early signal of how climate risk could reorganize the geography of housing demand in the US, and how entire swaths of property value could evaporate almost overnight if confidence collapses. Inland cities are not immune. In the Midwest, heavier rains are overwhelming stormwater systems, flooding basements and damaging foundations in neighborhoods never before considered risky. In the Northeast, powerful storms are combining with rising seas to swamp historic towns. Even places like Houston, far from the coast, are seeing recurrent floods that expose the limits of infrastructure designed for a different era. As these patterns spread, more homeowners will face the reality that flood risk is not confined to flood zones. Official maps, often outdated and incomplete, underestimate the number of at-risk properties by millions. Buyers who thought they were safe may suddenly find themselves trapped in a depreciating asset. The cascading consequences extend far beyond homeowners. Local governments, heavily reliant on property taxes, face shrinking revenues as values decline. When tax bases erode, funding for schools, police, fire departments, and public works suffers. Residents who can afford to leave often do, accelerating a downward spiral of disinvestment and decline. Small businesses, dependent on stable communities, lose customers. Contractors, realtors, and service providers see demand dry up. The very fabric of local economies begins to unravel. The federal government will inevitably be called upon to intervene, just as it has in past crises. But bailouts come at a cost, and they cannot undo the underlying physical reality of rising water. Managed retreat, relocating people out of flood-prone areas, is politically unpopular but increasingly inevitable. Programs that buy out homeowners and convert land back to wetlands are gaining traction, but they require massive funding and leave emotional scars. For every family that accepts a buyout, another resists, unwilling to abandon a place they call home. This tension between individual attachment and collective risk complicates policy responses and slows adaptation. Meanwhile, developers continue to build in vulnerable areas. In states like Florida and Texas, coastal construction booms despite the growing risks. Buyers drawn by sunshine and lifestyle often overlook or downplay the danger, encouraged by short-term profit motives and a real estate industry reluctant to scare away customers. This cycle of risk-taking ensures that more homes will be exposed to future flooding, deepening the potential collapse when confidence finally falters. The irony is that the very success of the US housing market, its role as a wealth engine for millions of families, makes it especially vulnerable to climate shocks. When so much personal and national wealth is tied to real estate, even small declines in value have outsized consequences. Add the compounding effects of insurance failures, financial market exposure, and community decline, and the ingredients for systemic crisis are clear. It is tempting to think of flooding as a localized issue, affecting unlucky homeowners in unlucky places. But the reality is far broader. Every mortgage-backed security, every insurance pool, every tax system tied to property values is exposed. Flooding is not just a threat to individual homes, it is a threat to the financial system that underpins the American dream. The warning signs are flashing. Analysts estimate that trillions of dollars in US real estate value are at risk from climate-driven flooding over the next few decades. Already, neighborhoods are seeing property discounts tied to flood history. Insurance companies are retreating, premiums are spiking, and federal programs are buckling. Banks and investors are beginning to adjust, but not fast enough to avoid shocks. The stage is being set for a slow-motion crisis that could erupt suddenly with the next catastrophic storm. The lesson of past crises is clear. Ignoring systemic risk does not make it go away. In 2008, warnings about reckless lending were brushed aside until it was too late. Today, warnings about climate-driven flooding are at risk of being ignored for similar reasons, because they challenge powerful interests, because they require painful choices, and because the consequences seem distant. But the water is rising now, and every delay makes the eventual reckoning more severe. Floods, unlike financial bubbles, are not abstract. They destroy homes, displace families, and erode entire communities. Yet their power to destabilize the housing market lies not only in their physical force, but in the way they expose the fragility of human systems built on outdated assumptions. If America continues to underestimate this risk, the collapse of vulnerable housing markets will not be a question of if, but when. And when that collapse comes, it will not stay confined to the floodplains. It will ripple through banks, insurance companies, pension funds, and local economies. It will erode confidence in the safety and stability of housing as an investment. It will challenge the very foundation of the American dream. That is why understanding and confronting this threat is not just a matter of climate policy. It is a matter of economic survival. When Americans think of real estate collapse, the memory of 2008 still looms large. That crisis was driven by reckless lending, ballooning speculation, and the collapse of mortgage-backed securities. But today, a new kind of threat shadows the housing market, one that comes not from bad financial practices, but from nature itself. Flooding, intensified by climate change, has begun to reshape the map of where it is safe or profitable to live, and the implications could be every bit as devastating as the last housing crash. To understand how this risk translates into market instability, we have to step into the lives of ordinary homeowners. Imagine a family living in a suburban community near a river in Pennsylvania. Their home has never flooded in the 20 years they've lived there, but last summer, record rainfall pushed the river past its banks. Water filled their basement, destroyed their furnace, and left behind mold that took months to remove. Insurance covered part of the damage, but premiums doubled afterward. When they tried to sell the house to move somewhere safer, potential buyers balked. The family discovered they were effectively trapped in a property that had lost its value overnight. Multiply that story by millions, and you begin to see the contours of a slow-moving crisis. The housing market is built on the assumption of stability, but floods introduce deep uncertainty. Real estate thrives when buyers and lenders believe a property will hold its value. Flooding erodes that belief. Every image of submerged streets on the nightly news, every report of insurance companies pulling out of a state, chips away at the confidence that makes the market function. If enough buyers begin to doubt, the shift from optimism to fear can be sudden, and once it takes hold, recovery is painfully slow. Consider how investors view risk. Pension funds, hedge funds, and banks have billions of dollars tied up in mortgage-backed securities, real estate investment trusts, and housing-related equities. If analysts downgrade properties in flood-prone regions, those investments weaken. If defaults climb, those securities lose value. What begins as localized flooding in one state can cascade through the national economy, just as a wave of foreclosures in one region once triggered a nationwide collapse. The link between water and Wall Street is closer than many realize. The role of government policy adds another layer. The National Flood Insurance Program, which underpins much of the market in risky areas, is increasingly unsustainable. As reforms push premiums higher, the affordability crisis deepens. Some homeowners can no longer pay. Others refuse to buy insurance, betting that floods will spare them. Both paths are dangerous. Without coverage, homeowners risk financial ruin. With skyrocketing coverage costs, the market risks collapse as buyers walk away. Either outcome undermines stability. Local governments, too, are in peril. They rely on property taxes to fund essential services. If values plummet, revenues shrink. That forces either painful cuts to schools, police, and infrastructure, or tax hikes on those who remain, both of which drive more residents away. Declining communities quickly become caught in a downward spiral that erodes resilience even further. Flooding thus becomes not just a natural hazard, but a financial contagion, spreading instability from homes to municipalities to the national economy. The long-term nature of the risk makes it even more insidious. Unlike earthquakes or fires, floods are predictable in their worsening. Sea levels are rising, rainfall is intensifying, and climate models show clearly which areas will suffer most. Yet development continues in vulnerable zones, often encouraged by short-term profits and the hope that disaster won't strike until tomorrow. That optimism bias keeps the cycle of exposure growing, ensuring that when collapse does come, its scale will be even larger. There are already warning signs. In Florida, some coastal homes sell at noticeable discounts compared to similar inland properties, a phenomenon analysts call climate devaluation. In Louisiana, entire neighborhoods have been bought out by government programs and returned to wetlands after repeated flooding. In the Midwest, rising flood insurance premiums are making properties unsellable. These are not isolated incidents. They are the early tremors of a much larger quake. What happens when entire swaths of the country become uninsurable? When lenders decide it is too risky to finance mortgages in certain regions? When buyers, spooked by headlines and insurance costs, abandon markets once considered prime? The answer is clear. The American housing market faces a structural crisis unlike any it has seen before. The comparison to 2008 is unavoidable, but there is one critical difference. The climate crisis cannot be bailed out or reversed. Policymakers may be able to slow the collapse through reforms, subsidies and investments in infrastructure, but they cannot hold back the tide forever. Every year of inaction allows the water to rise higher, the risks to compound, and the housing market to become more fragile. For homeowners, this looming reality is deeply personal. It means questioning whether the dream of home ownership, a cornerstone of American identity, is still as safe as it once seemed. It means facing the possibility that their greatest asset may become their greatest liability. For communities, it means reimagining development, investing in resilience, and sometimes making the painful decision to retreat from vulnerable areas. For the nation, it means acknowledging that climate risk is not a distant possibility, but a present financial danger. Flooding is more than water on the ground. It is a test of how prepared America is to face the economic realities of climate change. If the housing market collapses under this pressure, the shock will ripple across banks, insurers, businesses, and governments. But if action is taken now, through stronger building codes, honest flood mapping, managed retreat, and resilient infrastructure, the worst can still be avoided. The question is whether leaders, investors, and families will confront the truth before the crisis becomes irreversible. Delay may feel comfortable, but delay is deadly. Every year of hesitation adds billions in future losses and makes the eventual reckoning harsher. And so the call to action is clear. We cannot afford to wait until floodwaters claim more communities, until property values crash, until the financial system wobbles under the weight of climate reality. We must begin the work of adaptation now, not tomorrow. That means demanding transparency from lenders and insurers, pressing policymakers for bold reforms, and rethinking where and how we build. It means accepting that some places cannot be saved and must be surrendered to rising seas. Most importantly, it means recognizing that the stability of the American housing market, one of the most important pillars of the economy, depends on our willingness to face the truth about climate change. Crisis Lens exists to shine light on these hidden dangers, to make visible the risks too often ignored, and to spark conversations that lead to change. If you believe this story matters, if you believe Americans deserve to know the full truth about the future of their homes and communities, then stay with us. Subscribe to the channel, share these videos with others, and join the discussion in the comments. Together, we can confront this challenge not with denial, but with clarity, resilience, and the determination to protect the foundations of our lives before the waters rise too high.